Hello, everybody, and welcome to My Print Hash for week 32 of 2026. I'm your host, Cameron Otsuka, alongside Matt Dines. This week, we're going to cover the recent Yentervention, kind of a generational move that just happened. But number one, why was it deemed necessary? Matt will go into some history on prior Yenterventions and other kind of related pieces of history around the yen and prior U.S. interventions there. Then we'll go into some political jockeying that's going on partially behind the scenes. We're seeing some of it play out in the news media. And then we'll round out today's episode talking about why Japan specifically has this key role as a nexus in this Pax Silica AI build out. So with all that said, it's going to be a meaty episode, going to be heavily weighted towards this kind of front section here. So just be prepared for a lot of information from Matt. I'm excited for it. I saw a preview of the slides, and I think it's going to be really informative for everybody. So let's go ahead and get right into it. Matt, take us away. Yentervention. First off, what happened? What was it?
All right, cool. So the lead story this week is what we are calling the Yentervention. I know it's campy. I know it's cheesy. I think it works. It's the yen intervention. I'll just use it over and over. If you don't like it, comment, tell me to stop. All right. But what happened? The U.S. Treasury under Secretary Scott Bessent stepped in last Friday, July 31st, to support the Japanese yen, right? Shot past that 160 mark that a lot of followers have been tracking over the last few years. So in isolation, this intervention can look like just another move in the currency markets. But in the bigger picture, I view this as a major step in this larger transition that has been building up steam for really decades. So in hindsight, I'd expect this FX intervention to go down on the record as a catalyst event that opens up the system, right? Financial, geopolitics, international trade, everything to move into a next phase in this kind of big restructuring of all of those things: international trade, cross-border capital, finance, government power, and the alliances between those sovereign states that make up the nodes in the system. So right now, with the fog of war, kind of makes it hard to see the full significance of this yen intervention event in real time. Really, the discussion in the public forum has moved to, let's just call it, mudslinging this week, as we'll get into discussing. But most of the coverage and discussion around this event that you'll get, dealing with this topic at a surface level, I think right now it either looks like an episode of Real Housewives, like Scott Bessent, Nick Timiraos, or it's like a doomerism horror suspense thriller, like Stanley Kubrick, Alfred
Everything's
Hitchcock,
bad.
whatever,
Yeah.
about the inevitability of a yen collapse or a Japanese sovereign government debt collapse. I don't think either of those kind of treatments do proper justice to what this intervention is in that big picture context. I think it represents not just an important marker, but a key bridge that has to be crossed on this road towards a new monetary structure, right? For everyone involved, the Americans and the Japanese. So we'll get into that. All right. So a lot of the social media treatment is framing this intervention as some sort of omen of the yen's looming inevitable collapse. And that's understandable, I think, just given that Japan has now spent decades dealing with the monetary aftermath of the Nikkei bubble collapse in 1990. So everybody knows about repeated quantitative easing. I think they've done something like 20 rounds, negative interest rates, and just a long domestic economic depression. But that doomer framing is really just caught up by the problem, the paralyzation of horse blinders. I think what it's doing is myopically focusing, looking for the death of the thing while ignoring like the facts of life, what comes after death, and the decay of process is always followed by life, rebirth, etc. So in monetary history framing, the crash event or the death event creates the underlying soil for that later restructuring and rebirth to take place. And I think right now the doomerism is miscataloging the facts, or misreading reality, misinterpreting reality. Japan already had its 1929 style crash when the Nikkei bubble collapsed in 1990. Like in my view of the historical tape, or record of fact, that was the true destruction event. We saw fortunes disappear, wiped out, and never come back for the people who held them, right? Japanese savers, investors, speculators, right?
Yeah.
Who were just completely wiped out. So I think of the decades after that collapse in 1990, like can be understood as the first phase of the yen trying to move from that death towards a rebirth out of the collapse. So the comparison I would make is to the long restructuring process of the US dollar system after 1929. We're not going to go through it here. They'll just eat up all of our clock. But we're still in, I would say, that process, like within the offshore dollar system itself, but we're at the final tail end. So we've got two rivers like meeting, converging at a confluence here. So that transition we're beginning to see now in the yen with this Yentervention event is now touching on that transition that we talk about on Mindprint Hash, from the offshore dollar to the new thing that is emerging. We think it's the stablecoin asset dollar. But talking about that convergence is really just going to be the core of this episode. So I want to start from the very ground level here, like thinking about the word yen and just build up from first principles. The word yen was picked for the currency's name, like pulled out of thin air, but what we think of as currency, a unit, started centuries ago, 1870s, during the Meiji Restoration. But the word yen is pointing at the idea or concept of a circle or something round, and what it's really reaching at is the same monetary ideal or Platonic form as words like dollar or yuan are attaching to. Its value packaged into a standardized unit that can circulate, facilitate trade, etc. So, like I said, this modern yen, it's 150 years old. It was really started as similar to what we're dealing right now, death and rebirth. It came out of the Meiji Restoration. I'm not sure if I'm saying Meiji correctly.
Meiji. Yep.
Meiji. Okay. As Japan was working to create a monetary unit or standard of value that could interoperate with Western standards and the global trade, capital markets, etc. So the purpose was practical and civilizational. You want to facilitate trade, improve quality of life, allow profitable business and enterprise to grow, and then expand economic interaction beyond your previously limited domain, right? And that, like, thinking about that at the root is kind of revealing about what's going on here today as just like one latest chapter of events in a bigger picture story. The money, what we're actually trying to do as policymakers is it's an intent to build a tool that brings order and reduces chaos by hoping, like the hope is provide kind of a backdrop, a context where all of those good things we talked about can foster and develop. All right, so just want to keep that basic framework in mind when you see the interventions in the near future. This isn't just a story about Scott Besson or Nick Timiraos like duking it out on X and social media. It's not just a currency chart or a trading position. It's a story about civilization trying to create order out of chaos through money, right? Through establishing a defensible and viable sound, I don't know, sound, I don't want to use that term, it's loaded, but a monetary framework or system. So that struggle to build a workable and defensible monetary structure, this is like what we're looking at right now. It's both a Japanese story and an American story, and these two paths are converging, and I'll get into that here. So we'll go to the chart. This has got a lot behind it, but it's worth spending time here. So the current exchange rate move in the yen, like we're talking about 160, it's getting all the familiar social media treatment. The yen is at a 40-year low, or this is the first time the United States has bought the yen or intervened and bought the yen since 1998. This is the first time since X, type of post we could become used to the last few years. Those headlines are accurate within a limited frame, like I talked about the horse blinders, but the multi-decade chart tells a more useful story. So I've plotted out 13 intervention episodes, including the one this past Friday on the dollar yen chart going back 40 years, my entire lifetime, which gives you a context. Like these things take up lifetimes or play out over the course of lifetimes. They're that long. But these interventions take place on both sides of, just call it the bumper lane. Sometimes because the yen was judged to be too weak in FX markets, and sometimes it was too strong. And that gets at the fact that this target or this task, to find the right level of a money or a currency, what's its relative value in trade with another group of people, it's a constantly moving target. Policymakers are just like that. Essentially, it's the monetary version of Goldilocks and the Three Bears, right? You don't want it to be too weak, don't want it to be too strong. You're just always trying to find just right. But over a long enough timeline, you look at the chart and these interventions that we'll get into and talk about in a second. The chart really shows how many interventions there are. That's how difficult this task actually is. So finding permanent stability in a monetary system is about as hard as trying to nail Jello to the wall. So as you're looking at this, sorry if you're listening on a podcast, you're going to miss about half of the information because there's a lot of visual component to it. You still get value out of audio only, hopefully. But I want to start with the colors for each circled intervention episodes, 13 of them, as I mentioned before. So the green ones are interventions when the yen was considered too weak. And the remedy here is to find yen buyers, right? You want to tighten the excessive supply of money, take those off the market, find a balance sheet that wants to hold them, and then support the currency. The red circles are interventions in the opposite situation when the yen was considered too strong. So the remedy here is the yen needs to find sellers and issue more money into the system, right? So next, I want you to look at the flags next to each circled event. When a circle has only the Japanese flag, that means Japan's domestic institutions internally, like the Bank of Japan or the Ministry of Finance or related authorities, were able to handle the pressure themselves. That has worked in about half of the episodes over the last 40 years. In the other half, Japan has had to call in outside help, foreign institutions to step in. And the important thing, probably the most important thing that I'll mention here, whenever outside help was required, the consistent partner has always been the United States. There's also an important asymmetry in which partners show up, right? Whether the yen is too weak or too strong. When the yen is weak and needs a buyer, like the situation we're facing today, the United States is the external ally that steps in. So we saw this in the 1991, 92 interventions, again in 1997, 98, the Southeast Asian financial crisis, huge event, won't go into it here. And and then now in the present intervention. It's a solo act. It's U.S. only. We'll get at that more later. So you see that today with Secretary Bessent making the case publicly on the media rounds that the yen is significantly undervalued. So in that sense, the United States here, when it's tapped in to help from the local Japanese financial system and monetary authorities, Scott Bessent is again making the case publicly that the yen is significantly undervalued. So in that sense, the United States once again is operating under a belief that it is buying low, right? And that yen is too weak scenario. All right. So we'll talk about the level. You can see it on the chart here. We won't talk too much, but it's basically when the yen is weak, the U.S. steps in at the 120 to 140 range in the 90s. Today it's 160. But it's basically okay. So on the yen, it's actually the opposite of dollar-based pricing. First, it's priced in Japanese yen. So basically, what's saying higher number means the yen is actually weakening here. So later on, when the yen becomes too strong and FX intervention is needed, the United States, comes in and participates as a profitable seller. So that is a buy low, sell high American relationship with the yen across the cycle, right? Buying low and selling high is what you call actual investing. Hold on to that thought for later. All right. Now, when the yen moves to the too strong side, the external response from foreign help changes. The coordinated yen selling tend to appear after major downturns in the global economy, risk off scenarios, and the flight to safety type of event. So we talked about the Southeast Asian crisis being a by the weekend. Well, after the fact, the boom turned into bust, and when the yen is too strong, that's when foreign institutions come in to sell the yen, right? Or we say the post 9/11 period, the bust that followed, say the dot-com boom, once again, sell yen. Or after the horrendous Tohoku earthquake in 2011, right? The Fukushima nuclear disaster, the natural disaster that was riding on top of that. That drawdown, you saw a lot of need for foreign institutions to come in and intervene on the yen on the short side, right? Too strong a yen. So what we see here, look at the flags. All right, when the yen is too weak, America shows up to help. When the yen is too strong, not just America, but suddenly everybody raises their hand to help, right? EU is in every time. And then in the 2011 Tohoku disaster, you saw the entire G7 come in. So not just EU. Not just EU countries, Canada, UK, etc., were joining in on that one. So that's really the key here, key fact of the matter here. These interventions, number one, they're not uncommon, but the key fact of the matter, when we're on one side of the bumper lane, it's always US coming in buying low. When we're on the other side of the bumper lane, US also comes in and sells high, but everybody else comes in. When I say everybody else, I mean in the post-World War II Western coalition, everybody comes in to short the yen at the top. And that asymmetry is actually the buildup that we talk about. It's right here on the chart, the yen carry trade. Where do all of the shorts reside? So yeah, so think about the incentive that creates. If you're thinking about the United States is operating as a buy low, sell high partner, everybody else in the coalition tends to be a one-way perma short, right?
Right.
And as a permanent short, your economic incentives are not the same as a kind of, you can call it a pseudo opportunistic investor that the United States might operate as, buy low, sell high. But think about famous investors on the short side. right? Like Jim Chanos. If you're a one-way short, your incentive eventually becomes to short. Like you want to see Enron go to zero. That's how your position pays off. You're structurally bearish on the asset, on the thing, on the business franchise. But now just imagine that the short seller was funding his position with borrowed capital, right? That's the yen carry trade in a nutshell. So think about it in that framing. This is why the rhetoric and tone around the yen carry trade discussion matters. Look at the chart of these central bank interventions. Those who are willing to sell the yen whenever it's deemed too strong. These are the naked shorts with no offsetting buy low that came before that preceded their entry, like to their sell high trade. So over time, right? We're talking about lifetimes. My lifetime, grandfather's lifetime. This has been building up since basically the treaties were signed to end World War II. There is a like truly massive amount of capital exposed to the possibility that the yen does not collapse here and keep weakening, but instead strengthens. So if that strengthening forces these short positions to cover, the funding trade moves from profitable to existential very quickly. So a useful rule in moments like this is to watch and listen to who is screaming the loudest, and then in generally, if you pull down those rabbit holes, thanks Tom Luongo for coming up with that rule of thumb. That is going to often tell you who is caught deepest in the vice. So we'll dive into that topic in just a second. So one more structural point here. When the yen is weak and Japan needs foreign help, the United States is really the only viable ally. The dollar yen is the deepest and most liquid FX pair in the Japanese financial nexus. So the relevant foreign counterparty, overwhelmingly, it has to be the dollar, right? China might be like Japan's largest trading partner, and there's a ton of cross-border linkages, even like within the banks and loans between the two economies. But those two civilizations, long history of war, occupation, and like power struggle between these two makes Chinese ownership or like control over Japan's financial infrastructure a complete non-starter. So in this problem set we're facing, it for Japan, it really is right now the United States or nobody. So a little bit more on mechanics. Normally, Japan would support the yen by selling reserve assets to raise dollars and then sell those dollars to buy yen. But Japan's reserves include a massive stockpile of US Treasuries. And as we're at the tail end of this old offshore dollar era that I talked about 10 minutes ago, large scale treasury selling that Japan would need to do if it just operated solely on its own here would push pressure back into US markets through higher interest rates. Does it mean the US can't tolerate higher interest rates in the future? I'm just saying, like, not right now. Like, we don't need it right now. We'll deal with that later, and we can absorb them, but it's got to be managed on a like let the volatility escape over time, not all at once. So that creates a direct American interest in finding another route. And so last Friday, what we saw with the first Yentervention move was executed through the Exchange Stabilization Fund, or the ESF, using the direct route. It sold euros and bought yen. There's a signal there as well that we're selling the euro. We won't dive too much into it. But if the United States wants to provide additional support here or from here, those reserves custodied at the Federal Reserve Bank of New York, we need more ammunition behind them, right? If we want to win this tug of war. So the next stage is going to require like other facilities and operate through what we call the indirect channel, right? It's not just going to be pure buying and selling on FX markets. So think about that stage photo op of Besant's handwritten note to buy 10 trillion of Japanese yen. As it's choreography, right?
Yeah.
That first 5 to 10 trillion yen from the ESF gets the naked shorts and the yen carry trade rattled, but really it's just a start. So there's going to be more ammunition brought to the table. So that brings us to the next stage of this short-term discussion, to the Federal Reserve Bank of New York's FEMA repo facility. So the hot question now is whether the FRBNY's FEMA repo facility. Sorry, there's a lot of acronyms here. I'll just, you'll have to get used to them. There's a question now around the kind of the legal authority and the governance documents on whether this tool can be used for this specific purpose. The other aspect here, this is a COVID era tool, but it has a per counterparty limit right now at $60 billion. So right now, ever since the $5 to $10 trillion buy last Friday, July 31st, Secretary Bessent is now going out and arguing publicly, making the case not just for using that tool, but he wants the limit raised beyond $60 billion, right?
Yeah.
But
yeah.
take that in context with that stage photo, handwritten note. There's 5 to 10 billion dollars already deployed, or 800 billion to 1.6 trillion yen, right? As the starter piece, right? Firing up FEMA would bring another $60 billion in ammo behind it, or nearly like 10 trillion yen at that roughly 160 exchange rate. So, like, if you're thinking about this, what the heck's going on? Picture like an old world battlefield, like the movie Gladiator, where the armies are just lining up their massive amount of troops on two sides of a battlefield, right? So that's the dollar yen chart right now. That is the battlefield. And we're gonna see like the two sides here are the yen bulls and the bears at the end of the day. That's what it is, on opposite lines. And what Bessent is doing with these moves, think about it like that opening scene in Gladiator, right? Where Russell Crowe's just lining up all his troops. You're seeing this, like the staging of troops to show the other side how deep his lines are stacked. And so on the opposite side, that you'd call Scott Bessent a yen bull, right? On the opposite side of that, the yen bears, you're not really seeing, oh, we're lining up this many dollars. Well, as I think about it, I could go down a train here and spend 5 minutes talking about who's lining up our reserves on the other side, but I won't go there. But the opposition is really not lining up the troops on the battlefield to meet the show of force that you're seeing with Bessent doing, the ESF, the FEMA facility, actual troops, right? The opposition is it looks to me like they're mounting actions in the public discussion space to pressure the Fed to stand down, right? If we think about Scott Bessent as the general leading the army, well, to go to another one of the generals on his team, Fed, right? If you can pressure the Fed to stand down and take 60 billion troops off the field, you're looking at a totally different war. So that's where the public discussion has gone. And in all this mudslinging, Scott Bessent, Nick Timiraos, looks like Real Housewives, there's something much bigger going on here. But the basic point, get the Fed to stand down, or yes or no. Can you figure out a way through the board structure of the Fed to shut this down? All right. If and when those tactics fail, I think the possession is 9/10 of the law, as well as the law, probably lining up with Bessent's side, but we're going to know more as this plays out in the coming weeks. But if these tactics to block the Fed fail, they're going to be left with the choice to either call Bessent's push in of his chips to the center of the table. I know I'm mixing analogies here, and basically engage, or stand down and let the yen appreciate. Like we talked about, the yen appreciation, um, all the capital tied up in the yen carry trade, it may not be able to weather that. We're going to find out. All right. So mechanically, Japan holds a massive stockpile of U.S. Treasury IOUs in custody at the New York Fed. It's 1.14 trillion. I think they're the number one holder of the like listed on the tick reports. All right. So what the FEMA repo facility would allow Japan to do is borrow dollars against those Treasury holdings through secured repo lending. So similar to the basic structure to the repo transaction behind SOFR that we talk about, which is going to be like short-term maturities, overnight, 7-day, etc., for money markets. Or think about it like the BTFP in March 2023, where the Fed gave domestic U.S. banks short-term funding, like up to 1 year, to work their way out of the pickle they've gotten themselves in with the asset liability mismatch that the rising rates in 2022 just blew open potential holes that needed to be worked around. All right, so under this play, we talked about the $60 billion counterparty limit. Japan has $1.14 trillion in USDs or in US Treasuries, so they're well above that limit. And if you think about it, if Japan posts its Treasury bond as collateral, there's going to be a haircut taken. There's no credit risk, right? So if the argument's made this is risky, et cetera, it's like, dude, you need to go study and learn about what you're actually talking about. All right, so that would really, what this would actually do, you're creating dollars. You can come in, backstop the weekend, while also avoiding outright Treasury sales and the resulting pressure that we talked about on U.S. interest rates. But more important, what it would also do, it would give Japan and the BOJ breathing room to continue raising its own interest rates. They'll have more yen capacity on balance sheet to absorb the hikes, which would provide further support to the yen. So that is exactly why the proposal is so dangerous to anyone whose financial racket depends on maintaining a large one-way short against the yen. So at this point, these monetary mechanics and boardroom procedures have like morphed into a political fight over who controls the tools. And that's where we get into the Warsh credibility attack and the Scott Bessent response. So we've already established that there's a massive amount of capital riding on the outcome of this intervention, and that a meaningful portion of the old offshore dollar system is exposed to the yen carry trade. So if you're short the yen in size here, built up over multiple decades, any sustained strengthening creates a serious problem, because the covering your short itself would require you to become a yen buyer. So the 40-year intervention chart with the one-way support of the U.S. on the 2-week side, buying low, everybody participates when it's time to sell high. In my read, that's as close as we're going to get to a smoking gun filter on whose balance sheets are actually systematically exposed. So now if you take that discussion, like the tactics have moved into the public forum, and that's where like you're starting to see the financial media campaign and talking heads turn against this use of Bessent's Treasury facility and Fed policy tools for this purpose. So treat the volume and tone of what you're hearing from those pushing back as your signal or as information. All right. Like I said, who screams loudest is probably telling you which capital base is most overextended and most threatened by if this intervention would be successful. So you started to see this week, this is like, the highbrow level of discussion. Notably, there was a August 4th article in the New York Times where you're like just demonstrating that we're starting to see the trusted financial media coverage leaning towards like heavily questioning, skepticism, or like it's not a stretch to use the word scrutinizing the Treasury's action as far as the intervention. It's almost a copy paste of the noise that came around the similar episode last October with the FX intervention in Argentina, right? So you're seeing like think tank figures such as Robin Brooks at Brookings and Mark Sobel at CSIS, helping to steer the debate, to move the window of framing this solution as a public debt restructuring matter, and onto the governments themselves and away from the cross-border banking and financial channels themselves. All right. So these are sophisticated people who understand the mechanics that we've described this entire episode. So I don't think the important question isn't whether they actually understand the issue. The question that needs to be asked is why the debate is being redirected towards this particular frame at this particular moment. And again, the obvious answer is this is coming from whoever on the other side has the most to lose. And like, trust me, there is a lot to lose here. All right. So now we get in, I want to talk about Cameron, slide 10. Examining, if you look at the financial media coverage over the last couple of weeks, I got a collage here of mainstream media outlets. We got American Banker, CNBC, Market Watch, FT, some podcasts, but you see everybody hitting on this theme as though there's, I know we just lost John C. Dvorak with the No Agenda podcast, right? The media deconstruction. I mean, this is just an homage. John C. Dvorak, rest in peace. But you can see this targeted theme. Everybody is hitting on Warsh's credibility, and this predates the actual intervention exercise on July 31st, right? The July 31st, 31st. That came at the month-end close. What we really see here is like a sequence of just chatter. Starting, you start to see these on July 29th, and they just keep going this week. But they're moving towards this effort to question or call into question Kevin Warsh's credibility with markets, with whatever, right? So the way I'm thinking about this, right? Order of events. Last couple of weeks of July, into the Fed meeting, Warsh's credibility already in question, blah, blah, blah. This week, or then July 30, 31, also Fed meeting, July 29th, important marker. July 31st, we get the intervention. And then this whole week, the topic has shifted into FOMC, the FEMA facility, and what the next stage in escalation is going to look like. So if you think about this, like we talked about the troops lining up on two sides of the battlefield, right? The other side didn't line up any troops. What they actually did is like they showed they moved their actions or front ran the actions in the like public perception space with like an influence campaign. So in my mind, as an outsider trying to read between the lines and see the facts and piece them together, what looks like the smoking gun that gets to the heart of the matter here about the thing being fought over at this point is the Nick Timiraos 3-post thread dated August 4th, Tuesday of this week. So I'll skip the first two, bury the lead. But what you're looking at here, like we've talked about, the FEMA facility is the next $60 billion of troops on the field. That is becoming the center point, the next important fight to be held, right? As Nick Timiraos' tweet gets at here, this FEMA repo facility operates under the direction of a subcommittee, the Foreign Currency Subcommittee, or FCS, which seats beneath the FOMC, right? The Federal Reserve Open Market Committee. This is what everybody tunes in 8 times a year to watch the Fed chair give his discussion on what's going to happen with interest rate policy. So this 3-person FCF subcommittee is composed of Kevin Warsh, John Williams, and Philip Jefferson. And so, like I said, the immediate question is whether Japan should be allowed to use this FEMA repo facility for this specific purpose to support a yen that's deemed too weak. But you get into now, talk about the other two members of this subcommittee. John Williams, designer, architect, spearheaded the SOFR initiative. He obviously lines up with one camp of capital faction. He's not he's the opposite of an offshore dollar maximalist. Philip Jefferson is a Biden appointee. We don't know which way he's going to vote on this, but there's a chance he could vote with a Warsh and John Williams majority, just reading the political winds, the financial winds accurately. So it really comes down, if you think about it, the pressure campaign to question Kevin Warsh's credibility, right? It is really starting to look like it's getting into the heart of the matter, the most important thing. A 2-to-1 majority carries this subcommittee and takes that decision into what the Bank of Japan and what the Ministry of Finance could do to ultimately support the weak yen. So that is why you're seeing this discussion, in my opinion, move into the public space with this whole campaign to question or attack Kevin Warsh's credibility. So in my read, this whole Nick Timoreo's thread, it's not just describing an obscure governance issue. He goes one step beyond that, just giving you the facts. When he makes this statement, the last line, in practice, that subcommittee has always made decisions with the support of the broader FOMC. What we're actually talking about here, if you keep taking this to its logical conclusion, at the more aggressive end, the argument gestures towards moving authority away from this 3-person foreign currency subcommittee, where the decision-making authority is actually vested under its governance structure and the rule of law, and into its senior 7 of 12 FOMC board structure from which that FCS subcommittee is formed. So we should all be clear about the irony here. Only a few months ago, during the Warsh confirmation process, the financial establishment, political establishment, all of the above, focused on the central bank independence concept as a sacred norm that must never be threatened, right? And so now you're seeing the public campaign really, to my eye, lining up. You know, if you read between the lines, see the market for what it is. We're pressing directly up against the line of what would be outside interference in a decision assigned to central bank officials, specifically by letter of the law, 3 central bank officials. All right. So the real fight is not some abstract procedural debate. It is over whether Japan gets access to the secured dollar liquidity that's required to defend the yen without dumping treasuries into the market. But it's really way bigger than that. Like, the wealth tied up in the Nikkei bubble with that 1990 collapse that, got washed away. There are a lot of people whose wealth is derived from capital tied up in this offshore dollar complex that we've talked about, and that's like part of the capital base, or the funding base, is tied up in this yen carry trade. So there's a whole lot riding on the line here, and so far we haven't seen any public statements from Kevin Warsh or John Williams on this FEMA matter. They've largely stayed out of the limelight. But what we have seen, this was this week, is Secretary Bessent step forward as the public attack dog in this proxy war. So underneath all of this kayfabe, this is why I say it's Real Housewives is essentially where this has gone. But what's really going on in my mind, this is the direction the yen takes from here, um, whether it strengthens or weakens, right? The bulls versus the bears. Um, there's a whole lot riding on this outcome. And so Japan right now has moved into the center of attention as the key battlefront. Um, and its importance goes well beyond just the foreign exchange market. It's, you know, kind of we see this in other realms here, or on other planes in this big picture uh, era of transition. But Japan's a central hub for military and defense projection into Southeast Asia and the South Pacific. It's also a major industrial um, base, like to plug into global supply chains. Um, and it's also essential to capital formation required for the build out of this kind of 21st century AI robotics economy. So now that takes us directly into the whole Pax Silica Fund framework, the emerging like blueprints for the American plan for the 21st century order. So if you really like put it all into scope, um, what's going on here with the yen, like I where we started, you know, earlier in the conversation, this is the key linchpin. What happens here with the FX intervention will decide which way that like the course goes for all of these other, you know, processes that are up for grabs. Um, Cameron, I think that pretty well covers it. Do you want to get into Pax Silica a little bit from here?
Yeah. So I can flip over here to, I'm gonna be managing slides while Matt and I talk as well. So it's kind of like the three-person. I need four more hands to do everything. All right. So SoftBank, we're really going to first by talking about Pax Silica overall, right? So number one, you know, as Matt has mentioned across the board, he's mentioned Jacob Helberg, right? He's the Undersecretary for Economic Affairs. I think one of the architects of this Pax Silica agreement. He's definitely a known name in DC. He's been at talks. He's often, you know, a little bit behind the curtain in terms of the day to day. You don't see him coming out as strongly as, let's say, Bessent and Trump, etc. But he's definitely a key figure within the administration. But during the Pax Silica summit last December, he specifically calls out Japan as an essential partner, and as we've highlighted here, our collaboration with Japan is a foundational pillar of the entire partnership. So, you know, you're already seeing from the architect himself of Pax Silica, you know, obviously with other folks as well, but really Japan is a key piece of this entire roadmap.
Yeah.
I'm going to flip here. I know Matt is going to be able to have a lot more to discuss on this than I will, but first off, this is a really interesting map. When I first saw it, you know, this is from the Brussels Institute for Geopolitics. It's that icon in the bottom left. It's really hard to read.
One of the worst logos. One of the worst logos I think we've ever come across.
Yeah,
That's their actual logo.
It's interesting, but definitely hard to read. But this really lays out kind of the map of, just to quickly lay it out for you, there's 4 blocks in an overall square for a country. The top left is patent activity for semiconductors, top right is materials, bottom left is equipment, bottom right is assembly. And so within those, the colors mean whether or not they need to import them or export them, etc. But the key things to think about here are any blocks that are dark red, those are countries that have import dependencies on those materials. So just to point some out here, Thailand, for example, has a lot of red blocks out of the 4. India as well, so they're import dependent. Any that have a lot of green or a lot of purple, those are ones that they actually have export leverage. So they're actually producing specific materials, or they're producing specific items. You can see over in the middle here, South Korea, Japan, they have high. The purple is semiconductor patent design, as well as kind of greenish red, depending on what exactly we're talking about in each of those boxes. But maybe Matt, you know, you highlighted a couple or circled some of these in this green angular circular a map. I don't know even how would you describe this, but essentially Matt has circled several countries here. So maybe you can explain why you circled those ones specifically and kind of what you're seeing in terms of the in versus out from that green ring.
Yeah. Yeah. All right. So you start with number one. The map isn't, I like this because it frames the world. The center is the Pacific Ocean, right? This is the 21st century, not the 1492 to 2020, maps you see, like Western Hemisphere on the left, Europe in the middle, giant Asian land island on the right. This is the perspective, the supply chains that are being built out for the 21st century economy. All right. I highlighted in the green kind of fence post. Think about it this way. You got the West Coast on the US where the technology industry is. Think about the memory fabs in Boise, Idaho, Micron, or the semiconductor fabs, TSMC in Arizona. Those supply chains are in the domestic United States, like interior to the coast, so they're a bit protected. But really what they're doing is they're plugging in. If you think about it, you're connecting everything. Trade can still happen like we have been doing for 500 years, right? But the key thing is being able to connect the high-tech development, supply chains, like all of that value built up to ultimately get AI, robotics, all this cool stuff we've been promised, right? For the rest of our lifetimes, hopefully, or this is the objective, right? This is the project. But the key thing here, the United States needs access to all of these nations in the South Pacific, right? Core inputs to the supply chain. You also got to get the critical minerals, commodities, etc. So if you're thinking about this, you need to connect these things for the real economy, right? To produce the goods, physical capital, etc. But you also need to connect them financially. That's where Japan comes in, like the yen, why this thing is important, why the intervention, or why we've been building to this for this moment in the yen for 40 years. Think about it this way. If the US is the only firm getting long in size at 160 at an undervalued lend, we're buying up a stockpile of yen. Imagine what happens when the yen carry trade reverses and everybody who was running naked shorts has to cover, right? It's very easy to see.
Right.
The US and Japan can now financially link themselves on a new dollar standard, not the old offshore credit liability, infinitely rehypothecated standard, etc. But what's coming down the road, we talked about the stablecoin dollar, won't focus on that today. But all of this stuff, like this is what is trying to be put together. Like this is what the Pax Silica blueprint is actually representing. So this moment, what's going on here with the FX intervention, like this is the battle for the yen to continue building this out. The US winning this one versus the adversaries, or it's also not just the US winning, it's the Japanese domestic economy and its own sovereign authority also winning this one. So there's a whole lot riding on this. I guess we'll just leave it at that. And that brings us to the key node, the man in the middle, if you will, Masayoshi Son and SoftBank. So this thing, if you've heard about them in financial headlines, but it's difficult to understand, I think, and put it in context of the bigger picture. I'll try to do that here. SoftBank is a linchpin connecting the monetary story to the AI build out. So think about SoftBank not like a traditional bank doing loans, making deposits, but as a balance sheet that supplies the capital capacity needed to enable this larger technology build out plan. So now that makes monitoring SoftBank a key health signal in this machine that we need to monitor. All right. So the market's assessment of SoftBank's financial condition, look to the chart, can tell us whether this AI and Pax Silica build out is either gaining strength or encountering stress or resistance. So key detail here with the Frontier AI labs or model developers, right? OpenAI, they're currently private. They're funded through the venture capital kind of ecosystem. So we don't have public market price that continuously reveals valuation or prospects for the AI model build out of the trade. And they consume a lot of resources, a lot of capital. But SoftBank gives us kind of a shadow indication of that value because it books OpenAI exposure through its Vision Fund too. So if enthusiasm, liquidity, or kind of returns around AI investment and that whole complex start to weaken, we should expect that change to appear in SoftBank's earnings and asset values. So SoftBank just reported earnings for Q2 last week. I know it was a busy August for the yen, all of the above, but within Japan, think about this SoftBank balance sheet as a node that funnels capital. There's actually a lot of dollar borrowing loans funding these AI venture companies. I want to say SoftBank Vision Fund 2 committed, I want to say $40 billion to OpenAI's latest round in March. So just looking at the balance sheet, assessing the quality here, you've got a large exposure to Arm, right, which licenses processor architecture used in your mobile phones, low power devices, data centers, and other like high power consumer systems. And then you've got another 19.3 trillion yen on the balance sheet through their allocation of Vision Fund 2. That includes the OpenAI exposure. So roughly, if you think about it, you look at the stock chart, look at their earnings, all of that. This is really kind of one of the best looks we have into public mark-to-market pricing of this AI build out, and then that kind of intersects with Japan's role within this Pax Silica project framework that's under construction, and to a much on a much like broader level, the Japanese and United States monetary integration that we're seeing play out. So watch the yen, watch the FEMA decision, and then going forward also you'll want to watch SoftBank. They're kind of three windows that give you a look into the same underlying transition that's taking place. All right, so let's close it out. This one went way longer than I wanted it to, but we had a really meaty, complex topic to discuss. So the intervention that we're seeing take place, that's your surface level event. What's actually going on? I hope this helps you understand the foundational activity underneath the surface underneath the surface that's taking place in dollar liquidity, the yen carry trade, the questions about central bank authority, and then this even steers into industrial policy, defense alignments, and the financing of AI. I know I just threw a lot at you, but that tells you how important this little Yentervention episode is that we're seeing, and kind of how meaningful in the big picture this little event, this Yentervention is in the long-term development, this transition that we talk about on Mindprint Hash every week. So question, it's not just simply whether the yen goes up or down next week. We'll see how this plays out. The question is who wins and which coalition gets to build and capitalize the monetary and industrial architecture that comes next.
Great. Well, thank you everybody for listening. That's our episode for the week. As always, please follow us at Mindprint Hash, Substack, YouTube, X. Follow Matt at Levered USTs and myself at Cameron Otsuka. See you all next week.